to order. The title of today's hearing is America on Fire, FIRE being an acronym for Financial Independence, Retire Early. Will the crypto frenzy lead to financial independence and early retirement or financial ruin? Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. And I'd like to note that a Mr. Brad Sherman, who is a part of the full committee, without objection, will be accepted as a participant. With the hybrid format of this hearing, we continue to have some members and witnesses participating in person and others on the WebEx platform. I remind all members participating remotely to keep themselves muted when they are not being recognized. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may participate in only one remote proceeding at a time. If you are participating remotely today, please keep your camera on. And if you choose to attend a different remote proceeding, please turn your camera off. I now recognize myself for 2 minutes to give an opening statement. It is my pleasure to open the second in a series of Financial Services Committee hearings on issues related to cryptocurrency and digital assets. Most of us in this room are old enough to remember these financial calamities that cost so many so much. The 2008 mortgage crisis, the Alan Stanford Ponzi scheme, the Bernard Madoff Ponzi scheme. In each of these cases, and in others that I haven't enumerated, investors and financial institutions suffered severe losses, then sought and or received bailouts from the federal treasury. Their refrain seems to have been, keep the government out of my life until I lose money. So today, we ask, will there be a bailout of digital asset investors if their investments' market value drops to zero? If we believe that such is not the role of the federal government, should there be an amount or form of reserves required to backstop digital securities should they fail? Or instead, are today's investors in digital assets entirely reasonable in expecting the federal government to provide a backstop in certain cryptocurrencies should these digital assets become large enough to have a systemic impact on our economy? If so, should there be greater federal oversight and rating agencies to evaluate the risk and performance of these digital assets? Today's hearing will consider the answers to these questions and assess the systemic risks to the economy, as well as the risk of loss to individual investors posed by recent periods of extreme volatility in crypto assets that are not backed by any form of tangible collateral. It is now my pleasure to yield to the ranking member, whom I must congratulate, Mr. Emmer. Congratulations on your new station in life. And we yield to you for 5 minutes for an opening statement. I do look forward to working with you.
Thank you, Mr. Chair. I too look forward to working with you. I appreciate you holding this hearing today, and I thank you, and I give a big thank you to our witnesses for appearing before the committee. I look forward to all of your testimony. Financial technology and cryptocurrency are the future of the global financial system. In general, fintech lowers the barriers to entry to the traditional financial system and offers all consumers, no matter where they are, the ability to access convenient financial services at low competitive costs. Cryptocurrency is no exception, as we have seen from the huge consumer demand for these innovative assets backed by technology that is permissionless open and private. Cryptocurrency allows people to transact with each other in real time across borders for very little cost in a way that is so transparent and verifiable that it maintains more trust, actually more trust, than traditional financial transactions with a third-party intermediary. Most importantly, cryptocurrency and blockchain technology unlock access to opportunity. The open source nature of these technologies offer millions of Americans the opportunity to study the underlying code, develop blockchain projects, and launch their own businesses, all without having to ask anyone for permission. That's an incredible opportunity. Over the last few years, I've been fortunate to meet with many great crypto and blockchain innovators. The common refrain during our discussions is that they so badly want to develop their new crypto and blockchain ideas right here in the United States, but they don't because of continuing uncertainty with federal regulation and, perhaps more importantly, the lack of enforcement of existing laws and regulation. They're afraid to launch new projects that, for example, might classify them to be a, quote, money transmitter, even though their work has nothing to do with money transmission. Still, the thought of having to comply with an overburdensome state-based money transmission licensing system in the United States is too much of a challenge for these entrepreneurs to be worth their time and their investment. So they head overseas, where the regulatory compliance is more streamlined. I've also been told by two co-founders of a company who are in the midst of developing a new blockchain network that they wanted to hire American developers. But because there isn't a streamlined process at the SEC to determine what is a security, they couldn't pay American developers with their token. So they actually went out and hired a team of developers in Europe instead, where they can confidently comply with existing regulation. As I mentioned, fintech and cryptocurrencies are the future of finance, but we're missing out as a country because American entrepreneurs are still unsure of how to navigate our existing regulatory system. This means high-tech jobs are going overseas and capital formation opportunities for everyday Americans are being missed. All part of the chilling effect that comes when we do not answer the questions that industry leaders and consumers are begging for. Questions like, what digital assets are a security? What digital assets are a commodity? What digital assets are currency? Answering these questions will keep innovation here in America and unlock new opportunities for every American to access. To conclude, let's be clear that these things are already regulated, but we need clarity in application and enforcement of the existing laws and regulation. There are also areas where we can and should streamline our regulatory framework to ensure that we realize and benefit from crypto investment and innovation right here in the United States. I look forward to learning from the witnesses how we can address these challenges, and I yield back the remainder of my time.
The gentleman yields back. The chair now recognizes for 1 minute the chairman of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, Mr. Sherman of California, for an opening statement.
Thank you so much for this time. Those in the cryptocurrency space are naturally pro-crypto. Their fortunes, their relevance, their fame depends upon the success of cryptocurrency. Cryptocurrency is something you can bet on, but if people want to have the animal spirits to take risks, I'd prefer them to invest in equity markets to support the building of American companies, or the California lottery to support the schools in my state. Cryptocurrencies are highly volatile. So if one person makes $1 million and retires at age 45 and 9 lose $100,000, Coinbase makes money. The one millionaire goes on TV and says how wonderful it is. And 9 others do not retire in dignity, but instead become eligible for Medicaid. Cryptocurrencies can ultimately be successful only if they're successful currencies. And evading the know your customer rule is the one thing that cryptocurrencies have as an advantage to the US dollar. Cryptocurrencies have the political support of the patriotic anarchists who are rooting for tax evasion. I hope we shut it down.
The gentleman's time has expired. The chair now recognizes the chair of the full committee, Ms. Waters, for an opening statement. The gentlewoman from California.
Thank you very much, Chair Green. Congress and regulators face many challenges as we grapple with how to best regulate cryptocurrencies, including cryptocurrency issuers, exchanges, and investments. This committee is committed to providing not only more transparency in this minimally regulated industry, but ensuring appropriate safeguards are in place. And so we have begun a thorough examination of this marketplace. Today, I look forward to hearing from our panel about the risk of fraud and market manipulation that can hurt retail investors and regular consumers. Furthermore, I look forward to learning about the systemic risks presented by hedge funds rushing to invest in highly volatile cryptocurrencies and cryptocurrency derivatives. So thank you, Mr. Green, for convening this hearing today, and I yield back the balance of my time.
Thank you, Madam Chair. The chair now recognizes for 1 minute the vice chair of the subcommittee, Representative Williams of Georgia, for her opening statement.
Thank you, Mr. Chairman, and thank you to all of our witnesses for joining us today for this critical conversation. Often in Congress, it's up to us to write the rules of the road while the road is being built. This rings especially true when we talk about the rapid development of digital assets. We have to be sure that the legislative and regulatory frameworks governing digital assets keep up with the pace of innovation. What's at stake? Ensuring financial innovation is appropriately serving all the people. The people of Georgia's 5th District want financial services that are responsible and help them improve their lives. And it's our responsibility to make sure that any financial innovations, including in digital assets, meet that bar. I look forward to our discussion today. Mr. Chairman, I yield back the balance of my time.
Gentlelady yields, and thank you, Ms. Williams. It is now my honor to welcome each of our witnesses, and I'm pleased to introduce our panel. We have Ms. Eva Sue, who is the Financial Economics Analyst for Congressional Research Service. Alexis Goldstein is the Director of Financial Policy at the Open Markets Institute. Christine Trent Parker, who is a partner at Reed Smith LLP. Sarah Hammer, who is the Managing Director of Stevens Center for Innovation in Finance at the Wharton School of the University of Pennsylvania. Peter Van Valkenburgh, the Director of Research at Coin Center. Welcome to each of you, and thank you for being here today. The witnesses will be recognized for 5 minutes each to give an opening presentation of their testimony. Without objection, the witnesses' written statements will be made a part of the record. Once the witness has finished their testimony, each member will have 5 minutes within which to ask questions. For the witnesses in the hearing room, on the table in front of you is a time that will indicate how much time you have left. When you have 1 minute remaining, a yellow light will appear. I will ask you to be mindful of the timer, and when the red light appears, to quickly wrap up your testimony so that we can be respectful of both the other witnesses and the committee members' time. Without objection, your written statements will be made a part of the record. Once the witnesses finish their testimony, each member will have 5 minutes to ask questions. Ms. Sue, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you. Chairman Green, Ranking Member Emmer, members of the committee, thank you for the opportunity to testify today. My name is Eva Su, and I'm an analyst in financial economics at the Congressional Research Service, focusing on capital markets and securities regulation.
Ms. Su, we'll allow you to start again. Would you kindly depress, there's a button there to turn on your microphone.
Yes, on.
If it's on, would you bring it closer to you, please?
Yes. Is this better?
A little, but could you bring it a little bit closer, please? Let's try that.
How about this way?
I think that's better, but if you could bring it a little bit closer. As close as you can. Thank you.
Yeah, how about here?
Okay, we'll try that. Let's see if that
Okay.
works.
Great.
Thank
Thank
you.
you. Chairman Green, Ranking Member Emmer, members of the committee, thank you for the opportunity to testify today. My name is Eva Su, and I'm analyst in financial economics at the Congressional Research Service, focusing on capital markets and securities regulation. CRS provides Congress with analysis that is authoritative, confidential, objective, and nonpartisan. Any arguments referenced in my written or oral testimony are for the purposes of informing Congress, not to advocate for a particular policy outcome. In recent years, financial innovation in capital markets has fostered a new asset class, digital assets, and introduced new forms of fundraising and trading. Digital assets, which include cryptocurrencies, crypto assets, or crypto tokens, among others, are digital representations of value. The current regulatory landscape for digital assets is perceived by certain industry observers to be fragmented. Multiple agencies apply different regulatory approaches to digital assets at the federal and state levels, regardless of the terms used to describe digital assets. Depending on their characteristics, some digital assets are subject to securities laws and regulations that are designed to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Others, such as Bitcoin and Ethereum, are not considered securities and generally not directly subject to those requirements. The Securities and Exchange Commission is the primary regulator overseeing digital asset securities offerings, sales, and investment activities. My testimony focuses on issues related to digital asset securities regulation. Digital assets' increasing presence in capital markets raises policy questions regarding whether changes to existing laws and regulations are warranted. If so, when such changes should happen, what form they should take, and which agencies should take the lead. The current innovative environment is not the regulatory regime's first encounter with changing technology. In the past, some technological advancements have led to regulatory revamps, whereas others were dealt with through the existing regime. Regulatory oversight generally strives to balance the need to foster financial innovation with the objectives to ensure market integrity and investor protection as well. In general, policymakers contending with major financial innovations have historically focused on addressing risk concerns while tailoring a regulatory framework that was flexible enough to accommodate evolving technology. Current developments that raise policy issues include, first, digital asset exchanges. Some industry observers perceive digital asset trading platforms as functional equivalents to securities exchanges in buying and selling digital assets. But these platforms are not subject to SEC regulation, potentially making them less transparent and more susceptible to manipulation and fraud. Second, digital asset custody. Custodians provide safekeeping of financial assets. Digital assets present custody-related compliance challenges because custodians face difficulties in recording ownership, recovering lost assets, and providing audits, among other considerations. Third, digital asset ETFs. ETFs are pooled investment vehicles that gather and invest money from a variety of investors. ETF shares can trade on securities exchanges like a stock. The SEC has not yet approved any digital asset ETFs because of market manipulation and fraud concerns. Fourth, stablecoins. Stablecoin is a digital asset designed to maintain a stable value by linking its value to another asset or a basket of reserve assets, as seen in DM, formerly known as Libra, and Tether. In policy discussions, some suggest applying ETF regulatory frameworks to certain stablecoins. Others argue for more disclosure of the underlying reserve assets to expose potential deceptive activities. That concludes my testimony. I look forward to your questions. Thank you.
Thank you, Ms. Su. The chair now recognizes Ms. Goldstein. You are recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Green, Ranking Member Emmer, and distinguished members of the subcommittee, thank you for inviting me to testify today. I'm the Director of Financial Policy at the Open Markets Institute, where my work focuses on financial regulation and consumer protection. Previously, I worked as a computer programmer at Morgan Stanley in electronic trading and at Merrill Lynch and Deutsche Bank as a business analyst serving the equity derivatives trading desks. Earlier this year, the blowup of a single family fund, Archegos Capital, led to $10 billion in bank losses after the firm's bets on about a dozen total return swaps imploded. Because these sorts of derivatives aren't currently reported to the Securities and Exchange Commission on Form 13F, banks and regulators alike were entirely in the dark about Archegos' positions until it blew up. The extent of hedge fund and family involvement in cryptocurrencies lives in a similar regulatory blind spot. Chairwoman Waters, to her credit, has introduced discussion draft legislation to try and address some of these concerns with Form 13F, and I believe that Congress and regulators should also consider requiring that hedge funds report their cryptocurrency positions on this form. If a majority of hedge funds with billions of dollars in assets under management begin to hold significant positions in crypto, as certain surveys indicate they are interested in doing, it may produce dire risks for financial systemic risk and may induce future crises, as volatile swings in the cryptocurrency markets could lead to things like forced liquidations on their assets. In addition to hedge funds, large too-big-to-fail banks and Silicon Valley venture capital firms are also a growing presence in crypto. VC firms have already invested $17 billion in crypto firms so far this year, which is more than 3 times what they invested in all of 2020. If you combine this with the fact that some cryptocurrencies have a majority of their supply held by a very small number of people, it raises concerns around concentration. To take one example, as of February, the top 20 largest Dogecoin addresses held half of the cryptocurrency's entire supply. There are also broad investor and consumer protection concerns in cryptocurrency that I have personally observed as a user of crypto exchanges and DeFi platforms. In traditional financial markets, barring a serious liquidity crisis, if you buy something, you can generally assume you can sell it back, especially with a stock. But on DeFi protocols like Uniswap and SushiSwap, anyone can upload a new cryptocurrency token, anyone can add a liquidity pool for it, including malicious actors who design tokens that can be bought but never sold. These so-called honeypot tokens are so prevalent that some DeFi protocols include an explicit warning about them on their website. Some crypto investors try to read the smart contracts or code of new coins to look for common pitfalls and avoid scams, but this is an extremely high bar for non-programmers. Some of the more concerning areas I've seen in DeFi are on platforms that offer derivatives. Frankly, it reminds me of the over-the-counter derivatives marketplace before Dodd-Frank, which I worked in as a banker in the late 2000s. Things like the US-based DYDX, Open, which offers options on cryptocurrency, and Ribbon Finance, which offers structured products based on crypto. Recently, CFTC Commissioner Dan Berkovitz said in his speech that unregistered DeFi exchanges may not be legal under the Commodity Exchange Act. I've also used a DeFi protocol called PancakeSwap, which often advertises very eye-popping annual percentage rates in exchange for locking a pair of cryptocurrencies into the platform's liquidity pools. APRs are probably not the right metric to attempt to use for what the crypto community calls yield farming, as the rates can vary wildly even on a single day. But just to give you one example, in early May, PancakeSwap posted a tweet saying you could get a over 100,000% APR if you stake or locked in your Dogecoin on PancakeSwap. They later stated that that special rate was only there for 13 days, which is questionable to use for an APR. Users complained that the rate offered was nowhere near what they were advertising on Twitter. Yet they tweeted again the same day that, quote, "The longer you wait, the less free money you get," end quote. I believe that Congress should continue to examine if there are regulatory gaps that require new legislation in order to ensure consumer and investor protection in crypto and avoid systemic risk. Regulators should continue to monitor the space and ensure compliance with existing laws. Thank you, and I look forward to your questions.
Thank you, Ms. Goldstein. The chair now recognizes Ms. Parker for 5 minutes to give an oral presentation of your testimony.
Thank you. Thank you, Chairman Green, Madam Chair Waters, Ranking Member Emmer, and members of the subcommittee for the opportunity to appear before you today. And thank you to the subcommittee staff for their hard work in putting together this hearing. My name is Christine Parker, and I'm a partner in the New York office of Reed Smith. I'm actually joined today by my colleague Trevor Levine, who was kind enough to brave the heat to come to DC with me. My practice focuses on regulatory enforcement and transactional matters related to commodities, derivatives, and digital assets. I routinely advise both regulated and unregulated digital asset market participants in connection with a number of different federal and state regulatory and prudential regimes. At the outset, I want to note that there are a lot of use cases for blockchain and digital ledger technology for which cryptocurrency serves as the fuel. I urge this subcommittee to engage with organizations that are working at the grassroots level to establish industry-sponsored voluntary self-regulatory associations for digital asset and crypto markets on both a global basis and at the national level, because I think there is a lot to be learned from them. I also want to point out that if we are going to innovate how we regulate these new markets, it really calls for a new kind of financial regulator. At a minimum, we need financial regulators that reflect the diversity of retail investors who are active or want to become active in the crypto markets. As advocates for responsible innovation, I don't think the crypto industry has been very good at pushing forward diverse voices, but we can and we should and we will do better on that front. However, we are here today to talk about the retail investors who are trading in the crypto markets. And I know there's been a lot of focus on the recent volatility in these markets. And what does that mean for Congress, for the regulators, and for retail investors? Just a quick point. The volatility in the crypto markets, I think, is not solely attributed to their lack of regulation. I will point out that crypto exchanges such as Gemini and Coinbase are not regulated like the Chicago Mercantile Exchange and the New York Stock Exchange, but they are regulated by the New York Department of Financial Services as limited purpose trust banks. They are subject to AML, KYC requirements as any other federal or state regulated bank. And they're subject to the Commodity Futures Trading Commission, the CFTC, has anti-fraud and anti-manipulation authority over the purchase and sale of Bitcoin and Ethereum on these trading markets and has actively used that authority in this space. Separately, volatility is not unique to the crypto markets. Last April, the crude oil market went negative. And in February, natural gas markets were incredibly volatile due to Winter Storm Uri. And there are products that are offered on CFTC regulated exchanges that are available to retail customers that are based on market volatility. So some investors are actually seeking out assets that are based on volatility on these very highly regulated exchanges. That being said, the question that we're really grappling with today is how do we best protect retail customers who are actively trading in the crypto markets? I think it's somewhat problematic to just sort of simply equate the crypto markets with terrorism, tax evaders, and bad actors. Realistically, every member of the subcommittee has a law-abiding constituent who enjoys trading crypto. So what is in the best interest of this constituent of yours who's trading crypto right now? Access to crypto markets that operate under a clear regulatory framework with both customer protection mandates and opportunities for risk that are commensurate with the suitability of the investor. Right now, we have an absurd patchwork of regulatory regimes at both the state and federal level. We have regulation by enforcement, interpretation, guidance, interpretive guidance, and public statements from regulators. One regulator says that a crypto asset is a currency, another says it is a security, and the outcome of that is incredibly harmful to retail customers. This lack of clarity stifles innovation in the US and frankly drives retail customers to foreign exchanges. So how do we better regulate cryptos? The CFTC and the SEC should be empowered by Congress to move quickly to provide retail investors with a broader array of regulated crypto products that are attractive to market participants, but come with the robust market oversight of these regulatory regimes. This should happen now. Congress should also direct the SEC to immediately create clear, workable criteria as to which digital assets are securities and therefore subject to US security laws and regulations. Second, while regulators in New York and Wyoming in particular have been very crypto-forward regulators and will continue to be leaders in this space, Congress needs to pass legislation to provide for the federal preemption of the current state-by-state licensing requirements for the direct purchase and sale of cryptocurrency. This will ensure that these transactions are subject to the level of market oversight that we currently have in the futures and securities markets. The logical regulator here is the CFTC, but you must ensure that you fully fund them so that they can take on this mandate. Thank you for the opportunity to speak today, and I look forward to your questions.
Thank you, Ms. Parker. Ms. Hammer, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chair Green, Ranking Member Emmer, and members of the subcommittee, thank you for the opportunity to testify today. My name is Sarah Hammer. I am Managing Director of the Stevens Center for Innovation in Finance and Senior Director of the Alternative Investments Program at the Wharton School of the University of Pennsylvania. I also oversee the blockchain laboratory within the Stevens Center at Wharton. Additionally, I am Adjunct Professor of Law at the University of Pennsylvania Law School, where I teach an upper-level Juris Doctor course on financial regulation. Before I proceed, I'd like to note that the views I express here today are my own and not the views of the Wharton School or the University of Pennsylvania. Blockchain is a shared immutable ledger that facilitates the recording of transactions in a network. Today, blockchain technology infiltrates and powers a myriad of institutions, functions, and assets in the United States and globally. The use cases for blockchain are too numerous to cover in detail here, but they include decentralized finance, enterprise blockchain, cybersecurity enhancements, and even addressing climate change. The subject of today's hearing is cryptocurrency. At the outset, it is worth noting that there is no official public data source for cryptocurrency prices, market size, or volatility. This lack of data is a significant problem. However, unofficial data sources have estimated that the total value of the cryptocurrency markets may exceed $2 trillion. Investors in cryptocurrency include retail, high net worth, and institutional investors, such as private funds, corporations, and endowments. Retail investment in cryptocurrency may give rise to particular concerns about investor protection, given the possibility of fraud or business failure, the lack of disclosure, and the high level of price volatility. The Securities Exchange Commission is charged with a tripartite mission of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. At the same time, the SEC faces challenges in applying capital markets and securities regulation to cryptocurrency. Chief among these is whether the SEC has the authority to regulate a particular instrument. Currently, the SEC evaluates crypto sales through the lens of a test known as the Howey test, which evaluates whether an instrument qualifies as an investment contract for the purposes of the Securities Act. While the SEC has applied securities regulation to dozens of initial coin offerings based on the Howey test, there is still a lack of clarity as to whether it applies to a number of crypto transactions that currently do not comply with SEC registration and disclosure obligations. In addition, a number of exchanges that offer trading in crypto, including those that meet the definition of a security, do not register with the SEC. Given this, there is a strong need to establish a clear, sufficient, and appropriate regulatory framework for cryptocurrency. I turn now to the issue of systemic risk. As discussed, the value of the cryptocurrency market is estimated to possibly exceed $2 trillion, and it is characterized by very high levels of price volatility. Additionally, estimates are that more than 2,000 different cryptocurrencies currently circulate globally. For context, estimates of subprime debt prior to the Great Financial Crisis are less than $1 trillion. Moreover, since no official data source exists for crypto markets, financial regulators are at a distinct disadvantage in evaluating their regulatory options. Because of the infiltration of crypto into so many institutions, functions, and assets, the potential risks must be carefully evaluated in a coordinated fashion. In light of the risks and considerations of crypto, a myriad of agencies, states, and international standard-setting bodies are implicated. Thus, a key question for regulation is, how should we proceed, and in what forum? Importantly, a government authority already exists that could support the development of a clear, sufficient, and appropriate framework for regulation of crypto. Established in 2010 by the Dodd-Frank Act, the Financial Stability Oversight Council is the appropriate forum to engage in evaluating and addressing potential systemic risks, convening and coordinating federal rulemaking on issues that touch multiple agency jurisdictions, and consulting with state and foreign regulatory authorities. I believe that by leveraging the authorities of the FSOC to support the development of a clear, sufficient, and appropriate framework for crypto, we can address concerns about fostering innovation, providing consistency, establishing global reach, and balancing our regulatory objectives. Thank you.
Thank you, Ms. Hammer. Mr. Van Valkenburgh, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Green, Ranking Member Emmer, members of the subcommittee. Thank you for the invitation to speak with you today. My name is Peter Van Valkenburgh. I'm the Director of Research at Coin Center, which is an independent nonprofit that's focused on cryptocurrency public policy. The Bitcoin network has been processing transactions for longer than Uber has been offering rides. Bitcoin and other cryptocurrencies have enabled 3.1 billion transactions in the last 10 years, securing over $2 trillion in value. If cryptocurrencies were unregulated to this day, would that not be an incredible failure of our regulatory system? As I'll outline, it's not a failure because over the last 10 years, cryptocurrencies have been regulated. Some of that regulation, of course, does come from the technology itself. The scarcity of Bitcoin, a total supply of only 21 million, is not preserved by the goodwill and honesty of the participants on the network. It's secured by a transparent, peer-to-peer accounting technology, a public blockchain that makes fraud trivially cheap to detect and absurdly expensive to commit. But much regulation has also come from the federal and state governments. The on-ramps and off-ramps where people buy and sell Bitcoins for dollars and safekeep them are heavily regulated. They are state-licensed money transmitters, or else they are chartered banks and trust companies. Before offering any services to Americans, they must prove minimum capital requirements, post bonds, and open their doors to yearly examinations. They are also classified as financial institutions under the Bank Secrecy Act. They must register with FinCEN, know their customers, and share the details of suspicious activities with law enforcement. Cryptocurrencies like Bitcoin and Ethereum are commodities, but many crypto assets meet the flexible definition of an investment contract and are therefore securities, which means their issuance and their trading are regulated by the SEC. Cryptocurrency derivatives are regulated by the CFTC. Finally, anyone who markets a cryptocurrency service or tool that is deceptive or fraudulent is liable under various laws enforced by the CFPB, FTC, SEC, CFTC, and state attorneys general. And the results of all of this regulation speak for themselves. In 2020, only 0.34% of all cryptocurrency transaction volume involved a criminal sender or recipient. Despite several high-profile hacks of overseas exchanges, no American exchange has suffered a substantial hack or loss of consumer funds. Operators of money laundering exchanges overseas have been arrested. Sales of unregistered tokenized securities have been targeted by SEC enforcement, and criminal ransomware rings have had their servers seized and their ransoms recovered. All of this has happened by sensibly applying existing laws to the cryptocurrency space. We don't need new regulations. And all of this has also happened while preserving the fundamental value of cryptocurrencies as open access platforms for financial services and innovation. Unlike any other transactions technology that works online, an open blockchain network is accessible to people that banks and tech companies would rather ignore than serve. With the rise of central bank digital currencies from authoritarian nations happening in tandem with the rise of Bitcoin, we are at a decision point as an advanced technological society. Are we willing to accept some risks if it means we can eliminate the choke points to economic participation that further inequality and stifle innovation? Or would we prefer to strengthen those choke points and outlaw alternatives in the hopes that a powerful elite will smartly choose who should and should not have access to powerful tools and volatile markets? For every transaction that we want blocked, there is another transaction we should celebrate for being unstoppable. Yes, there are some criminals making payments on the Bitcoin network because banks won't bank them. There are also pro-democracy activists in Belarus and anti-police violence protesters in Nigeria taking donations on the Bitcoin network because local banks won't bank them. Nonprofits Bisol and Feminist Coalition in Nigeria raised millions of dollars in Bitcoin donations last year. Donations they were forbidden from accepting by a corrupt or otherwise uncaring banking sector in their respective countries. In America, we don't always agree, but no matter what, we are tolerant and expect everyone to have the opportunity to stand up and fight for their own vision of the good. Crypto innovation embodies that aspiration. It's rough around the edges, but holds some values above all. Every node is an equal. No one's voice should be censored, and work rather than privilege is what counts in consensus. Thank you.
Thank you, Mr. Van Valkenburgh. The chair will now recognize the gentlewoman from California, the chair of the full committee, for 5 minutes for questions.
Thank you very much, Mr. Green. Ms. Goldstein, earlier this year, PricewaterhouseCoopers released their third annual survey of hedge funds in the cryptocurrency market. According to this survey, cryptocurrency currently accounts for 10 to 20% of all assets under management for 1 in 7 hedge funds. Over 60% of the hedge funds surveyed expressed a desire to start investing in cryptocurrencies or to accelerate their existing investments in cryptocurrencies by the end of 2021. Hedge funds often manage funds on behalf of mutual funds, pension plans, and other institutional investors, which affect millions of regular consumers and investors. Ms. Goldstein, do you see any systemic risks associated with hedge funds investing heavily in cryptocurrencies? And I'm more interested in this just having listened to the last presenter who talked about the choke point that we should not be so concerned about. What do you think?
Thank you, Chairwoman Waters, for the question. I'm very concerned about the presence of hedge funds in cryptocurrency. I think we've seen with the Archegos meltdown this year that when banks have prime broker relationships with hedge funds who are conducting, or family funds as Archegos was, who are doing risky things, it can redound to the taxpayer-backed financial system. Credit Suisse lost billions of dollars. All the banks lost some $10 billion. If hedge funds get farther into crypto, they don't care about direction. They'll go long, they'll go short, they can use leverage. There are lots of cryptocurrency exchanges like FTX and Binance and many others that allow people to use insane amounts of leverage, 100 times to 1. And hedge funds are the perfect client to use those sorts of leverage. So what happens if a huge number of hedge funds who have prime broker relationships with too big to fail banks all happen to be in similar crypto positions, whether it's long or short, and there's massive volatility in the market? They may have to sell some of their other assets. It may lead to margin calls in their non-crypto assets, which could lead to forced liquidations and sort of redound to the banks themselves in the form of counterparty risk. So
Let me ask you, are there any reporting requirements hedge funds must comply with that would provide regulators and the general public more transparency regarding which hedge funds are most heavily invested in cryptocurrencies, and which of these institutional investor counterparties may also be exposed to potential risk?
Chairwoman, there are not, to my knowledge, because cryptocurrency is not currently reported on the Form 13F. It's not seen as an ownership interest. And so regulators are essentially totally in the dark about what hedge funds' cryptocurrency positions are, and I suppose have to rely on the financial press or trying to figure out based on the transactions on the blockchain and de-anonymize certain addresses and figure out who are the hedge funds. But there's no formalized way for regulators to know how much hedge funds are in crypto.
Ms. Hammer, you spoke to this issue somewhat. Would you give me your knowledge about what kind of oversight do we have now? What agencies have what responsibility, and what should we have?
Chair Waters, thank you for your question. I too have concerns about crypto trading by private funds. And one of the key issues, as I discussed in my opening statement, is transparency and the availability of data. In the crypto markets, we have no official public source for data. Investors are operating based on online websites. There are sometimes disparities over prices and interpretations of what volatility may be. And in some ways, it harkens back to credit default swaps prior to the great financial crisis. That was a market that was traded almost exclusively over the counter and highly unregulated. When the great financial crisis hit, we saw that credit default swaps exacerbated the risks. But once we regulated them and instituted central clearing counterparties, we had an official data source and an oversight regulator such that we could identify where the risks lay. I think the same is true for crypto. And as Ms. Goldstein said, the issues related to leverage and whether it's appropriate or not for some of these assets are extremely important. I do believe that at a high level, the authority of the FSOC to convene to coordinate the regulators is crucial, because we're talking not just about markets issues or private fund issues. We're talking about crypto within banks. We're talking about crypto within insurance companies and other non-banks, and that can implicate taxpayer dollars in a number of different ways. So in our system, the FSOC can convene to coordinate those authorities to work together.
Thank you very much. I yield back the balance of my time.
The gentlelady yields. The chair now recognizes the gentleman from Minnesota who has served on the FinGen Task Force for 5 minutes.
Thank you, Mr. Chair. And this is interesting, following on the testimony, the questions we just heard. Mr. Van Valkenburgh, let's start with this idea that there's a need for regulation. When people promise investors wild profits from proposed new digital tokens in an initial offering, is that regulated?
A promise of future profits reliant on the issuer's efforts is basically the Howey test. It's how we classify things as investment contracts. And so the SEC would probably treat those offerings in all cases as securities. They regulate issuance and trading.
Well, let me keep going. I want to come back to that one because I want to talk about what the SEC would probably do and why that's a problem. When people make bets, again, Mr. Van Valkenburgh, on the future price of cryptocurrencies or trade with leverage, as we've heard referenced, is that regulated?
So bets on the future price of an underlying commodity are swaps or futures. These are commodities derivatives, and the CFTC has jurisdiction over that kind of trade and those markets.
So yes, it's regulated.
Yes.
Can companies sell and transmit, and this probably goes to the first bit of testimony, can companies sell and transmit cryptocurrency without identifying their customers? Is that regulated?
That's heavily regulated, and while Representative Sherman said that the one advantage of this is avoiding KYC, I have to argue that every U.S. exchange is BSA regulated. They have to know their customers, file suspicious activity reports, and this has been the case since at least 2013.
So let me do the prices of cryptocurrencies like Dogecoin have been quite volatile and seemingly susceptible to influence by statements from persons and groups, maybe even manipulated, as was suggested by one of the opening statements here today. Is that regulated, Mr. Van Valkenburgh?
So as an open source open network cryptocurrency, Dogecoin likely does not qualify as a security. To the extent that that line is unclear, yourself, Congressman Emmer, have introduced excellent legislation last Congress that was bipartisan and co-sponsored by Soto and Khanna that would help clearly delineate that line between securities and commodities. But if we assume today that Dogecoin is a commodity, it is still a regulated commodity for various purposes. Specifically, in the manipulation context that you raised, the CFTC has the duty to investigate and prosecute manipulation, including at commodity spot markets under their CEA authority, Section 6C1, which Dodd-Frank added to the Commodities Exchange Act. As SEC Chairman Gensler recently testified, there is in some ways a gap here because unlike traditional commodity spot markets, which are like cattle auctions, I'm buying a commodity from you, you're selling it to me. These markets have much higher volumes and a lot more retail participation. So accordingly, it may be appropriate to extend market supervision to these entities. Another reasonable approach that I think would follow Chairman Gensler's recommendations is another piece of legislation that you introduced last Congress, the Digital Commodities Exchange Act. I'm sorry, Representative Conway, former Representative Conway introduced the legislation, but you co-sponsored it. And for that, we were grateful because it would create a reasonable guardrail-based approach to market supervision for places where people are trading these commodities, even at the spot market level.
Well, and I'd add, I'd also introduce the Securities Clarity Act, which provides clarity for the SEC and token issues to swiftly determine when and if a token is a security. In the short time we have left, I believe that we do have the regulatory framework, the laws in place. People don't get to run in this country under the radar if they're complying with KYC and all the other regulations that are out there. Would you agree, Mr. Van Valkenburgh, that the real issue here is, while we can do some work perhaps as Congress on the margins to clean up some of this, the real issue is the application of existing regulation and laws has not been consistent, and there has been little enforcement in terms of court decisions or things that can give us precedent so people in this area know what's right and what's wrong.
I think that's right. There's a certain wisdom to our flexible and open standards for investor protection in this country, like our securities laws that have these broad and flexible standards. However, they only work if controversies end up in court and judges make clear rules about new application of those laws. And one thing we've seen is a replacement of a lot of decisions made by judges, acknowledging the interests of the parties, with administrative guidance that is not always as clear as it could be. But the underlying laws are sound and should be applied.
Thank you.
The gentleman's time has expired. The chair recognizes the gentlewoman from North Carolina, Ms. Adams, for 5 minutes for your questions.
Thank you. Thank you, Chair Green, Ranking Member Emmer, and Chairwoman Waters for holding the hearing today. To our witnesses, thank you as well. Ms. Parker, there's a great deal of interest from both the public and from members of Congress with respect to the current regulatory framework overseeing cryptocurrencies. So as the Vice Chair of the Ag Committee, I've heard plenty of discussion from my colleagues about not only who should regulate cryptocurrencies, but how they should regulate these entities. So as you alluded to in your statement, many of these discussions have centered around the roles of the SEC and the CFTC. So how are cryptocurrency markets currently regulated in the U.S.? And is this level of oversight and regulation sufficient protection from the attendant risk posed? Parker.
Thank you. Thank you. That's an excellent question. And sort of like you, I come from the commodity side when I'm looking at these markets, and Bitcoin and ETH are the two tokens that we have a very clear regulatory framework. They're commodities. And so at the spot level, the cash level, the CFTC has generally not been active in that space in terms of sort of the robust market oversight that they provide to their futures exchanges. And that's just because the function of the commodity markets. They sort of arose from commercial entities coming together to buy and sell their, pork bellies and, orange juice concentrate and wheat and corn and soy. And so, those markets we don't really have established trading spot markets for physical commodities or any form of commodity. So Bitcoin is sort of a novel application as an intangible physical commodity. It's sort of a novel application of these laws and these systems that have existed for almost 100 years. So what I would recommend, what I think makes sense, is that the CFTC is a very sort of robust and experienced market regulator. I think it makes sense to draw digital asset spot products. So I'm not talking about other physical commodities. I'm not talking about financial commodities, just digital asset spot commodities. I think it makes sense to pull them into the CFTC's market oversight framework and apply those sort of market conduct and market surveillance requirements that are imposed on the CME and ICE to these spot markets, because they—
Parker, I want to move on if I can. I'm trying to get another question, but thank you so much. So Ms. Sue, let me pivot to focusing on consumer protections. In my opinion, we've spent too much time over the past few years focusing on what happens on Twitter, but when it comes to cryptocurrency, volatility, Twitter has been front and center. In January, we watched Bitcoin spike with each Elon Musk tweet. We watched it fluctuate in the months thereafter. So let me ask you, what are the most concerning risks to investors in cryptocurrency in the marketplace, and how can those risks be mitigated most effectively by regulators? Ms. Sue?
Yeah, thank you. I think from an investor protection perspective, if you look at capital markets related concern, there are three groups of primary risks we consider. Market volatility, as you highlighted, is definitely front and center, but the traditional way to handle it is through disclosure and investor restrictions. By that, we mean you provide material information about the risk, so investors would go into risk-taking in an informed way, so they would price the risk accurately. Similarly, with investor protection regarding restriction, it would be if you deem the instrument to be highly volatile and highly risk relative to the risk tolerance and the financial cushion certain individual investors have, you may exclude those investors from such investments.
Okay.
Other risks relating to like fraud and the scams, so obviously you handle it through rulemaking, enforcement, reporting, and then the third category, which people usually not paying particular attention, that is safekeeping functions like the lost password. I think you're probably generally aware, like 20% of certain digital asset was lost due to the lost key. So
Yes,
safekeeping and custodian service may remedy that.
Thank you, ma'am. Thank you very much. I'm out of time, and Mr. Chairman, I'm going to yield back.
The gentlelady's time has expired. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thanks to the panel for being here. It's a very important hearing we're having here today, and I think it's something we need to be looking at. But one of the aspects of being here is a lot of times people draw a line in the sand very early on, and they take an early position on something, especially when it's dealing with technology, because it's something either don't understand or there's this fear factor. And I've seen that with cryptocurrency because a lot of times we don't see the forest for the trees. And in this case, I think there's something that we miss out on because we have either decided we're for or against cryptocurrency. And that part we're missing out on is the blockchain technology that's underlining, which I think is very valuable for us in this nation, especially in the federal government. And I have been advocating for a long time that we utilize, or at least we look very strongly at using blockchain technology as a solution to our our cybersecurity issues here in this nation. When you consider the federal government, And we know that we've had cyber attacks. There's been loss of data, and people's personal data has been inadvertently disclosed, caused a lot of issues. That isn't that hard to do when you consider how many points my personal information and others' personal information reside within the federal government. I mean, there's duplication of data in every place that my social security number, my date of birth, my address, phone number, all of this resides is another a system that's susceptible to attack. And all it takes is one weak link. And then you've exposed it. I mean, if you look at it as a veteran, my information's at the VA. From years of working in business, it's been with various departments, Social Security Administration, you name it, IRS. You look at all the different databases. I did a count one time, there could be 47 different data points that just my information would reside. And all it takes is the breach of one of those. Because of the decentralization of blockchain, it seems to me that that may be the solution to the cybersecurity problems that we have in this nation. So, Ms. Hammer, is this something that you would agree with, and can you describe how the blockchain technology could be used to enhance cybersecurity?
Congressman, thank you for that excellent question. I appreciate the chance to talk about the potential benefits of blockchain technology. It's absolutely something that I would agree with, and certainly something that we work with on a day-to-day basis at the Stevens Center at Wharton. As you mentioned, blockchain is a decentralized technology, and that is key because it has no single point of failure. So there are many different uses for the technology, in addition to cryptocurrency. With each new block in blockchain, the previous blocks are stored, and this creates a fully traceable history log. So it can potentially have many cybersecurity applications. Blockchain can therefore be used to create security profiles for user data, such as you mentioned, and it protects the data by decentralizing it. In addition, blockchain technology incorporates something known as public key and private key security. So public key infrastructure, much like an email address, can be used to authenticate and authorize parties. And private keys can be combined with it for end-to-end security and encryption of our data. Blockchain can be used for many different means in cybersecurity. It can decentralize security devices, such as a home security system, to discourage hackers. It can protect websites by decentralizing domain name servers, such as separating an IP address from a name. And it can be, in fact, combined with other security protocols like biometrics in order to strengthen our cybersecurity options. So I fully agree there are many applications for blockchain technology, and it's important for us to remember this is the technology that powers crypto. But the technology itself also has many applications, and we behoove ourselves to consider those innovative possibilities.
And that's the challenge I've had, is separating what some would consider the stigma of cryptocurrency from blockchain. In the remaining time, I got one other question that if you could answer. Do you have concerns with a potential central bank digital currency?
Thank you, Congressman, for that excellent question. And I know that central bank digital currency has been the subject of other hearings in this forum. And certainly it's something that's being studied really across the country by many different academics and not-for-profits. I think it's important to consider that central bank digital currency could take many different forms. It could be blockchain powered, it could be not blockchain powered, and run along a traditional database system such as we do currently. There are concerns about central bank digital currency. Some of them relate to issues around privacy and whether it actually achieves the objective of having a central bank digital currency, because rather than a decentralized system, which cryptocurrency is or blockchain is, having a central bank digital currency would concentrate our private information and therefore could potentially be a target for hackers. At the same time, I recognize there are
The
some...
gentleman's time has expired. Would you kindly give the rest of your answer in writing and submit it?
Absolutely. Thank you.
Thank you very much. And when I have my time, I may give her the opportunity to finish with my time. The gentlewoman from Georgia, Ms. Williams, the vice chair of the subcommittee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. My top priority in Congress is ensuring that those most marginalized remain at the center of our policy considerations. When it comes to digital assets, this means making sure that investors of all experience levels have equitable access to information about the digital assets that they're investing in. Ms. Hammer, how can regulators best communicate with all consumers, especially those who may be investing for the first time, about any risk associated with investing in digital assets and ways to avoid predatory behavior in the market?
Congresswoman, thank you for that excellent question. And as I mentioned in my oral testimony, investor protection is a key concern and priority when we think about cryptocurrency. And I return to what I recommended in terms of coordinating federal agencies, because investor protection, consumer protection, and even ERISA and the Department of Labor are implicated when we think about investing in these markets. Not every investor is the same. Investors have different risk profiles, they have different periods of time that they can invest in, and not every asset is appropriate for every vehicle. Today, we're seeing cryptocurrency being introduced into things like retirement funds. We're seeing the rise of cryptocurrency amongst younger investors through different applications. And so I do feel strongly that, number one, coordination through the FSOC, through the federal financial agencies is extremely important, both from a consumer protection perspective and investor protection. And number two, that we have the data and the resources to evaluate what's happening in the market. Without an official public data source, I think that we're a little bit in the dark about what the proper regulatory framework should look like.
Thank you. It's important that we ensure consumer protection when it comes to digital assets, but we also have to be sure that we're protecting the health of the broader economy as the use of digital assets expands. So, Ms. Hammer, more on this. Given that digital assets can change rapidly in value, are there legislative considerations that Congress should keep in mind to ensure any risk to the broader economy is minimized as investment expands in these assets?
Thank you, Congresswoman, for that question as well. And I do believe systemic risk is a key concern. I do believe that the Financial Stability Oversight Council is the proper authority to consider systemic risk under Section 120 of Dodd-Frank Act. It actually has a specific mandate to do so. The fact is that cryptocurrency has really infiltrated many different aspects of our financial system. And regardless of what we may think the benefits and costs of that may be, it is the reality today. Not only do investors hold crypto in their individual portfolios, but we see it in private funds, as Ms. Goldstein mentioned. We see it in banks. We have permitted banks to serve as custodians. We have national trust banks that are operating as crypto companies, and we have 50 different states that are looking at a myriad of crypto rules. I think at last count, 31 states were actually looking at crypto legislation in the current session. So this level of activity can be useful if it's innovative, but I think the key thing is that we have a race to the top and not a race to the bottom. And there are some things that should be regulated on a federal level. As far as what a specific legislative mandate would look like, I think that's to be determined after substantive study by the FSOC, after we've established some public data sources and there's clear coordination amongst the agencies.
So knowing that we need more research and investigation around this, I'm thinking more in the lines of some of my priorities in Congress, which are ensuring consumer protection and the benefits to financial inclusion for more people. Mm-hmm. And so are there any considerations that you have in mind for Congress that specifically speak to those two areas?
So thank you, Congresswoman, for that point as well. I think the issue of financial inclusion is crucial when we think about crypto. As we digitize our economy, the reality is that some people may be included more and some people may be included less. And I tend to think globally because that's kind of the research that we do at the Wharton School. When I think about financial inclusion globally, there are 1.7 billion people who are unbanked, and 2/3 of them do have mobile phones. Now, that may differ from what we have in the US. I think that having legislative priorities around consumer protection related to these assets would be important, but I also think that Clarity in that space and international coordination is key because the technology, going back again to the uses of the technology, has many beneficial functions for others in other areas who may not be so lucky to have stable currencies. They may be subject to political and economic instabilities that make using crypto an important method for them to run their businesses and to support their families.
Thank you, and my time has expired.
Thank you.
The gentlelady's time has expired. The chair recognizes the gentleman from Tennessee, Mr. Kustoff, for 5 minutes.
Thank you, Mr. Chairman. Ms. Hammer, if I can continue with you just briefly, I know that you were finishing answering Mr. Loudermilk. Was there anything you wanted to say in conclusion to his questioning?
Thank you so much, Congressman. We were discussing central bank digital currency, and I wanted to acknowledge that there may be privacy concerns around central bank digital currency, but emphasize that there are many different iterations that the technology can take. And I think going back to some of our earlier discussion, one of the key priorities that we focus on in our work related to fintech and blockchain at the Stevens Center is financial inclusion. And so when I think generally at a very high level about CBDC, I believe that that is a focus that we should continue with, and it's an important topic of discussion related to crypto as well. Thank you.
Ms. Hammer, if I could, along those lines, Vice Chair Quarles from the Fed, I believe on Monday, I'm going to express some skepticism about central bank digital currency. My question to you is, and we've talked about innovation and not stifling innovation, do you personally have concerns if we move slowly and say the Chinese accelerate? Can you play that out? What happens over 12 months, 24 months, 5 years?
Thank you, Congressman, for that question. And I know it's an important topic for all of us as we think about CBDC. To be honest, I don't have any particular expertise on China and our policy as it relates to China. I would say that one of the things that I think is valuable about thinking about blockchain technology generally and CBDC as it may relate is how it can improve our financial infrastructure and our financial system. We live in a world today where it takes days to clear and settle a payment. We live in a world where we have intraday risk between counterparties who are trading. We have an antiquated central clearing counterparty system that's in need of a revamp in some ways. And so I believe that we should be doing everything we can to modernize our system and that we should be taking advantage of the available technologies. The key thing from my perspective is regulatory clarity. I think that clarity is required for businesses to innovate. I see it every day in some of the companies that we work with. For a company to develop a product or create a go-to-market strategy or raise money, they need clarity in the law. And this is an area where they just don't have it on particular issues. So my belief is that we should be working in a coordinated fashion to provide that.
Thank you, Ms. Hammer. Mr. Van Valkenburgh, if I could with you, inflation is a concern for people across the country, certainly in my district in West Tennessee. I know in an interview recently, you talked about or you advocated essentially that a consumer may want to buy Bitcoin because it could be a way to balance an investment portfolio against the threat of inflation. Could you expound on that, please?
Sure. So the intuition here is fairly straightforward. Bitcoin is the world's first digital commodity, and it functions rather like gold, except it's gold that you can send peer-to-peer over the internet. Now, as to the wisdom of any particular investment in a portfolio, I think most people agree that diversity is how we can achieve greater financial stability for ourselves and for our major institutions. And so my point in that previous interview was simply that as part of a diversified portfolio, one might be interested in owning some Bitcoin, along with some gold, along with some stocks, American industries, overseas industries, in order to achieve some balance and a hedge against the risk of inflation, should we see it being pronounced.
And you may have answered this, but would you advocate that strategy for the lack of a better word, the average retail investor?
So I think we've got guardrails in place now for these Bitcoin spot markets, for example, that make that a safe bet as long as we have good investor education, which is always a perennial problem. But if you go to the right places, the American-run companies, they are state-licensed money transmitters, they're New York Department of Financial Services chartered banks and trusts, and these are safe places where a customer will be given clear information about what they're buying from a person who's posted a bond, proved minimum capital requirements, and has a robust regulatory structure around them to ensure investor protection.
Thank you, sir. I thank you. I thank the other witnesses, and I yield back.
Gentleman yields back. The chair now recognizes the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes to ask her questions.
Thank you so much, Mr. Chair. We all know cryptocurrency like Bitcoin currently consumes enough energy to power a small nation. And the Cambridge Bitcoin Electricity Consumption Index is one of the most cited cryptocurrency energy estimates. Right now, it estimate sits actually at analyzed consumption of 66.14 terawatt hours. That's actually around a third of the energy consumption of Facebook, Google, Amazon's data centers combined. But due to the decentralized nature of cryptocurrency, even the Cambridge model is just a small, not precise estimate, and their upper bound is probably as high as 159 terawatt hours each hour. As Bitcoin miners compete against one another for increasingly scarce tokens, energy usage increases. And so, one of the things I want to talk to you about, Mr. Valkenburgh, how can we better measure the energy consumption and energy resources of cryptocurrency to the account for its carbon footprint?
So I agree that the Cambridge, sorry, there's a bit of an echo when I'm responding. I agree that the Cambridge data is our best shot right now at looking at this question. What we have a benefit of is knowing everything that the peer-to-peer ledger tells us. It's shared and open. It's not a proprietary standard from a corporation. And the peer-to-peer ledger shows us how much work these miners are performing to make sure that transactions get in blocks and they're not censored by some third party or some government that wants to coerce certain transactions or block certain transactions. It's this vibrant competition between miners that guarantees that the miners cannot form a cartel and choose to systematically exclude certain persons from this financial system. When you have them compete and when you have their evidence of their competition in the form of proof of work calculations on a public ledger that any person can audit independently, you get that censorship resistance. As far as energy usage, I'm sorry.
No, go ahead. I need to get to my next question because I really want to talk about the carbon footprint.
Okay. I'll be brief. I'm sorry. So as far as energy usage, it's worth noting that the traditional financial sector uses an estimated 5 times more energy than Bitcoin. Now, granted, the traditional financial sector moves more money, but it is worth noting that Bitcoin energy usage does not scale per transaction. So most of the costs are the fixed costs of setting up an open peer-to-peer system that's robust. And we have technologies like the Lightning Network that can bundle millions of transactions into that existing system without a meaningful increase in energy. So it's possible we can have an open financial system that's censorship resistant using 1/5 of the energy of the current financial system, if we were to eventually move more transactions.
Ms. Goldstein, thank you. Ms. Goldstein, is cryptocurrency fundamentally incompatible with carbon neutral future?
Congresswoman, thank you for the question. I think it depends. It depends on the cryptocurrency. It depends on which system it uses for validation. So proof of work, I would argue, is the most carbon intensive of the validation systems in cryptocurrency. This is the one that Bitcoin uses. This is the one that Ethereum currently uses, but is trying to move away from. And that's because it's effectively a lottery system. Any miner can try and compete for the 6.25 Bitcoin reward that is generated every 10 minutes. And everyone is essentially trying to guess the address of the next block. Some people describe this as solving complicated math problems. But you have a lot of people competing for a single reward, and it generates a lot of energy. I think as more cryptocurrencies embrace different validation methods, whether it be proof of stake, proof of history is another one. Perhaps the footprint could be reduced, but it seems unlikely that Bitcoin will move away from the proof of work method. And as you cited, the Cambridge index, when crypto was very high, when Bitcoin reached its highs in May. We saw an estimate of 143 terawatt hours, which is more than the consumption of Argentina and more the consumption of Norway. And so I think the answer is it depends, but I think the proof of work validation method is a climate incompatible.
Well, no, it's just a recent study out of China suggested that without taking any actions to curb the greenhouse gases produced by electricity generation for Bitcoin mining, that they could see like 130 million tons of carbon per year. So, Mr. Chair, my point is climate crisis is here. We need to do everything we can in our power and in our purview to really, truly reduce carbon footprint and so many other things that we're trying to do in addressing that. I saw firsthand what was happening in my community as we saw record rainfall. But I really do appreciate this committee hearing, and I yield.
The gentlelady yields back. The chair now recognizes the gentleman from South Carolina, Mr. Timmons, for 5 minutes for questions.
Thank you, Mr. Chairman. Some of my Democrat colleagues have painted a broad brush against cryptocurrency as the purview of charlatans and scammers. In fact, Mr. Sherman has called for an outright ban on cryptocurrencies in the US. If we could, just for a moment, take a deep breath and heed the words of President Obama's own CIA director, Mike Morrell. In a recent report, he said that Bitcoin's use in illicit finance activity today is extremely limited and that blockchain ledgers are a highly effective crime-fighting and intelligence-gathering tool. He urged for a more fact-based dialogue between industry and government to ensure real risks are mitigated and the opportunities for potentially revolutionary technologies are not squandered. Mr. Van Valkenburgh, is this the road we are headed down? Are cooler heads prevailing, or will alarmism win out?
So I've been lucky to have the job that I've had for the last 6 or 7 years now, where we've gotten to meet with all the regulatory agencies that have some piece of jurisdiction over cryptocurrency, both in the Obama administration and now in the Trump administration. And I've always been impressed by the level of knowledge of that one person or maybe small group of people within the agency that's focused on this technology and focused on reasonably applying the existing rules to the risks presented by the technology. I think at the regulatory level, we've seen cooler heads prevail for a long time, and I'm grateful for that. We've had reasonable regulation from an anti-money laundering standpoint, counter what Representative Sherman suggested. We've seen KYC and AML at all of the US exchanges and robust suspicious activity reporting. And I've talked to law enforcement who have actually said they prefer doing investigations when it's on an open blockchain network because there's a single source of truth, which is a ledger, rather than a number of dubiously well-held records at international financial institutions.
Sure, thank you for that answer. It really frustrates me when I hear members of this committee imply that Americans are not smart enough to know that investing in cryptocurrencies carry risk, or even the capital markets more broadly. We heard a similar tone in the GameStop hearings as well. They won't come right out and say it, but I find it insulting that members of this committee feel that their constituents don't know what they're doing when they make investments. I'm not going to patronize the folks back at home in my district. Do we have a role in making sure they know what they are getting into? Absolutely. But let's stop implying that our constituents don't know what they're doing. My next few questions are for Ms. Hammer. There's a common misperception, which we have heard several times today, that cryptocurrency is, quote, unregulated. However, we have seen the SEC and other regulators at the state and federal level be proactive in enforcement actions and providing guidance to how businesses can offer services in relation to cryptocurrency. Can you describe the current regulatory state of cryptocurrency in the United States and regulations crypto companies have to comply with in regards to consumer protection?
Thank you, Congressman, for that excellent question. And it definitely covers many of the issues that we've discussed here today and the complexity of the regulatory framework. The reality is that crypto and crypto companies receive different types of regulatory treatment throughout our regulatory system. This is how our system works. The Internal Revenue Service issued a notice in 2014 that crypto would be treated as property, but if you are paid in crypto for your work, it is treated as income and taxed as such. The Securities Exchange Commission may regulate cryptocurrency as a security if it meets the criteria of the Howey test, unless that particular asset is eligible for an exemption. In some cases, crypto may be regulated as a commodity by the CFTC. And there are many different types of companies that interact in the crypto world now that have different authorities, such as a National Trust Charter from the Office of the Comptroller of the Currency. And as I mentioned earlier, we have a number of states that are innovating their own regulatory frameworks. So my key issue is that we need regulatory clarity in our policymaking. And I believe that we have an authority in place through the FSOC to lead that at a high level. The FSOC has a mandate under Dodd-Frank Section 120 to coordinate around issues related to potential systemic risk. And in addition to that, it has the ability to form a technical or advisory committee, including one that would work with the states. In addition, the FSOC is charged with consultation with international standard-setting bodies. And we've talked about a number of issues today that are international in nature. In fact, crypto crosses borders. There are places where there are gaps in the regulation, and the best way to address that is through international standard setting.
So do you think that the federal agencies have the tools necessary to coordinate their efforts around blockchain and crypto regulation, or do you think it's going to require congressional action?
I believe that we have the authority in place to coordinate through the Financial Stability Oversight Council. That said, I think we have a lack of clarity in the regulatory framework, and I strongly believe that we need to have official public data sources. In order to create a framework for cryptocurrency regulation, we need a map. And to have a map, we need data about where is crypto, where do the risks lie, et cetera.
Ms. Hammer, I'm sorry, my time has expired. I appreciate your answer. With that, I yield back. Thank you.
Thank you.
The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Good morning to everyone, and thank you, Chairman Green and Ranking Member Emmer, for hosting this important hearing. And of course, thank you to the witnesses today. I think it's easy to fall into a trap of believing that cryptocurrency is too technical for everyday people, that trends like GameStop and crypto are funny, weird coincidences that might make you rich. The fact is that the crypto market represents more than $2 trillion in assets, and $2 trillion matters to everyone. In this committee, it's our responsibility to look out after the financial system. I watched my neighbors lose their homes in the great financial crisis, and many neighborhoods in my district never recovered. I'm glad that we have not faced another crisis like this yet, but I'm very worried about the future. The fact is, we don't know all the risks cryptocurrencies create for us, and we know that cryptocurrencies are extremely volatile. We know that some of our largest banks are figuring out ways to get into them, but we don't know how concentrated ownership is. And we don't know how exposed our hedge funds already are. So in short, we know that crypto is big, but we don't know all the threats that it can pose. To Alexis Goldstein regarding open markets. Ms. Goldstein, it seems like many of the cryptocurrency proponents are at least honest. They want to get around regulations. How much of the appeal of cryptocurrency is just regulatory arbitrage instead of real innovation?
Thank you for the question, Congressman. I come at this from the perspective of someone who worked at Merrill Lynch and Deutsche Bank. Well, Merrill Lynch prior to the 2008 financial crisis. I worked for the over-the-counter equity derivatives trading desk before Dodd-Frank, when there was not regulation and all the trading was essentially opaque. And the cryptocurrency markets reminds me of that time. And there's been statements in this hearing today that all US-based exchanges have know your client requirements, which is true, but that's not the only place that US users can trade cryptocurrency. There are DeFi platforms, and I have yet to come across a single DeFi platform that has know your customer requirements. And so there are a number of ways to sort of evade some of the so-called safeguards that are already being touted as being in place. And I think, we need to look at what CFTC Commissioner Dan Berkovitz recently said in a speech, which is that some of these DeFi platforms are operating as unregulated, unregistered exchanges and may be illegal under the Commodity Exchange Act. I also think that we need to be concerned about leverage. Leverage both by institutions, but also leverage by retail investors. Retail investors in the stock market traditionally can't have more than a 2-to-1 leverage. But in cryptocurrency markets, many individual investors can get up to 125-to-1 leverage, and that can wipe you out quite quickly. And so opportunities in the space, unfortunately, for regulatory arbitrage, and I do think that that is some of the reason that they have been successful to date. I do think that the regulators should take a close look at their existing enforcement abilities, though, to see what can be done about that.
Thank you. I think you just got to the second question I was going to ask you, and that is, what are the most important things that regulators can do to keep crypto from threatening our financial system?
Well, Congressman, I'll take a shot at elaborating. I mean, I do think that in some ways the United States is behind. There's been a lot of recent regulatory activity. Canada has pursued enforcement actions against Bybit and KuCoin, among others. Japan has warned Binance. Germany has warned Binance about their so-called tokenized stocks, which are essentially crypto assets that track the performance of stocks and look very similar to me to the kinds of equity swaps or total return swaps that crashed the Archegos family fund. We recently saw the UK's FCA tell Binance that they need to put a warning on their website as of today saying that they are not registered with the FCA. And I think in some ways the US regulators are behind international regulators to putting out these sort of consumer warnings. So that's one thing that they could do. Another thing that they could do is look at leverage by retail investors, right? Why is there this difference between the access to leverage of retail investors in the stock market and in the crypto markets? And as I said in my opening statement, I think it's very important, whether it's Congress or the regulators, we pursue an avenue to ensure that private funds like hedge funds are disclosing what their cryptocurrency positions are so that the regulators can get a handle on any systemic risk concerns.
Thank you so much. And with that, I yield back, Madam Chair.
The gentleman yields. The chair recognizes the gentlewoman from Texas, Ms. Garcia, for 5 minutes for questions.
Thank you, Mr. Chairman, and thank you for calling this very important hearing on a topic that's been on the minds of many of us. The issue of crypto assets is so important to us because we must understand what the financial marketplace of the future will look like. Digital assets present an exciting new frontier with the potential to bring the unbanked into our economy. In fact, 12.2% of Latinos and 13.8% of Black households were unbanked in 2019 compared to only 2.5% of white households. But this is not the first time I've discussed that, and I'll continue to discuss it. While cryptocurrency is a new frontier, we must be cautious to make sure that we protect consumers from any avoidable risks. We need to bring the disenfranchised Americans to the financial fray, but we must also look at the bigger picture to make sure that we do not inadvertently allow a system to grow that grants too much market power to a few decision makers. It's our job as lawmakers to protect the consumers from financial abuses. This includes protecting the sovereignty of the US dollar. We cannot allow anyone to compete with our US dollar. Without a sovereign dollar that represents the primary form of currency in this country, we risk destabilizing our financial markets, and I would also suggest that it would destabilize global markets. We must protect the value and merits of the US dollar, both in cash and digital form. Stable coins such as Facebook's Diem preventing sovereignty risk to our domestic currency. In other words, there is a risk of these stable coins replacing the US dollar and undermining the Federal Reserve's ability to perform its critical functions as a central bank. The World Economic Forum has warned its member countries of this risk, and the Bank for International Settlements has urged countries to form their own central bank digital currencies so they can offer access but still protect the sovereignty of their currencies. Last Congress, I introduced a bill to regulate managed stable coins as securities. Pegging them to a currency without proper regulation like Facebook has done with Diem is a step forward, but it does not address all the risk. Ms. Goldstein, I wanted to start with you. How urgent is this need for regulating stable coins and protecting the US dollar?
Congresswoman, thank you for the question. I think stablecoins it's an urgent need for regulators to look into them. Thankfully, we've already had state attorneys generals looking at the problem. Letitia James in New York has looked at Bitfinex, which operates the Tether stablecoin, and they've recently reached a settlement. And so Tether, you can no longer buy Tether in the state of New York. But I think there are a lot of questions about what is Tether actually backed by? They recently had to disclose a number of their reserves, which included commercial papers and cash-like products, but they had very little actual cash. They had some commodities, they had some other digital assets. And I think, there was recent reporting, I believe it was in the Financial Times, where they asked some of the large banks who tend to be one of the major counterparties for commercial paper, and they said they hadn't done any business with Bitfinex. So who are they doing business with? I think this is an opportunity to make sure that stablecoins are actually based on something, right? And we're not just relying on faith that it's actually pegged to some denomination of the US dollar or another currency. And I think one perhaps way to approach that would be to have this, central banks issue central bank digital digital currencies. But that's not the only way we can tackle it.
Right. Well, and we hear from some, well, you can't do that. It's not about regulation. We can't go in there as a government and always just regulate. We gotta allow for innovation. Do you see that it is possible to strike the balance where we protect, those innovation and we allow that to occur, but balance the need for the sovereignty of our dollar and balance the protection that we need for consumers?
Congresswoman, yes, I think we absolutely can achieve that balance. I don't think it's unreasonable to want to ensure that something that pretends to be pegged to one US dollar actually is and isn't capable of breaking the buck and people losing their funds. That's not to say that there isn't existing problems in the financial system, right? I think there may be similar problems with, money market mutual funds, right? And their sort of ability to peg themselves to the dollar and break the buck. But we can always do better, and we can strike the right balance to both protect consumers and also encourage innovation. I don't think that they're in conflict.
Well, thank you. And I did have one more question. I'll submit it in writing, Mr. Chairman. I see that my time is down to 3 seconds, so I'll yield back.
The gentlelady yields back. The chair recognizes the gentleman from Ohio, Mr. Gonzalez, for 5 minutes for questions.
Thank you, Mr. Chairman, and thank you to our panel. In a way, I'm sort of encouraged by today's hearing, because I think there's more broad agreement than is normal in this committee, at least amongst the panel, the majority of the panel, that we do need clarity. We do need clarity with respect to how we are going to regulate in the space, because we are pushing a lot of the innovation overseas. I hope we get that clarity. Mrs. Parker, I want to start with your testimony. You suggest, to my earlier point, that this uncertain regulatory environment does choke innovation and pushes projects overseas, correct? Thank you. And it forces Americans to do things like use VPNs as a workaround. And I think you rightly highlight that this is a bad outcome for Americans.
That's correct.
Thank you. You also say that regulators are hesitant to get involved when relevant members are, your words, relevant members are hostile to crypto. Subcommittee chairs on this specific committee, they would qualify as relevant. I won't.
They qualify as relevant, but not hostile.
Right. Some potentially. So, assuming regulators are listening, and I didn't want to put you in that box there, but you did say it. Listening, I'd encourage them to listen to the full committee and not quote relevant members who say ridiculous things, like people should invest in the California lottery instead of cryptocurrency, and suggest that if it's possible to lose money, that some people are going to make money and others are going to lose money, that whatever that thing is, whatever that instrument is, ipso facto should be banned. And also people who suggest that because there are money launderers and bad people who use cryptocurrencies, and there are, we know that, that it should be banned. I would like to cite a statistic by Katie Hahn, who broke up the Silk Road scheme a while back. 99.9% of money laundering with fiat currencies goes unprosecuted. 99.9. So, you know, the commentary around whether we should allow cryptocurrencies to exist on AML lines, I would ask, compared to what? Compared to fiat, where 99.9% goes unprosecuted. So I want to shift now to Mr. Van Valkenburgh. Another comment is made, well, it's highly volatile. And because it's highly volatile, there is necessarily systemic risk, and we should ban it because it's highly volatile. Here's some bubbles in the crypto space. 2011 went from $1 to $31 down to $2, no systemic risk. 2013, 13 to 266, down to 65. 2015, $65 to 1242 to 200. And then obviously in the last year, we've seen it go from a couple thousand to 60 grand, back down to 30 and bounced up. At any point, Mr. Van Valkenburgh, did the federal government have to step in and prop up the cryptocurrency markets or save anybody?
No, by definition, cryptocurrencies are unbacked. We've heard some members question whether that's wise, but something that's not backed doesn't have promises associated with it. And so there aren't promises to be disappointed and someone to be bailed out in that case. It's like gold. How would you bail out the price of gold? Who would you pay?
Exactly. And then with your final or my final minute, I'd like to talk to you. There's a comment that, you know, people are going to lose money, and that's definitely true. Can you compare blockchain and cryptocurrencies to the early internet? Maybe use the pets.com and Amazon analogy if you could.
Absolutely. So these are brand new systems that do something amazing. They allow people across the world to coordinate, to perform, and provide a service that previously could have only been performed and provided by a big company. So just like the internet suddenly gave us the ability to all have our own blogs and not necessarily have to rely on the New York Times or the Wall Street Journal, the nature of Bitcoin is quite radical. It allows us to rely on ourselves in addition to centralized entities. And the radicalness of that innovation is something that people will get excited about for the right reasons and sometimes overexcited for the wrong reasons. So I think it's a good metaphor.
Right. And so there is risk in the system, but with risk comes great reward. And if you want to ban risk, well, guess what? You also ban reward and you ban innovation. And so I thank you for all that. And with that, I yield back.
Gentleman yields back. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is recognized for 5 minutes for questions.
Especially after the last gentleman's comments, I have a lot to say. I'll use my 5 minutes to say them. Of course, as I pointed out in my opening statement, and thank you, Mr. Chair, for allowing me to make an opening statement, those who live in the crypto world have their relevance, their fortunes caught up in making this successful. We're told that, well, cryptocurrencies are fun and useful, and there might be somebody in my district who enjoys trading them. Well, one thing that would be useful would be a $10,000 bill. It would occasionally be used to buy an automobile, but it would be uniquely valuable for those drug dealers. We'd make their lives so much easier when they have to deal these $100 bills. Imagine if they had a $10,000 bill. And our natural tendency is to try to facilitate and help people do their financial transactions. But I, for one, am not looking for a more accurate heroin scale to make sure that one drug dealer doesn't get cheated by another. We're told that that you have to be for blockchain because, you have to be for cryptocurrencies. Otherwise, you're anti-science. I am for the internet. I am for semiconductors. I am for computers. I am for blockchain. That does not mean I have to be for a cryptocurrency or, for that matter, for that $10,000 bill that would make the lives of some of our constituents easier. We've got to keep pace with China. China is close to banning all cryptocurrencies. They are going to protect their economy, protect their currency, and protect their tax collection system. If we fail to keep up with China, we will fall behind. The biggest threat to Bitcoin is Ethereum. The biggest threat to Ethereum is Dogecoin. The biggest threat to Dogecoin is Catcoin, Dogcoin, and Hamstercoin. There is an unlimited number of potentially popular cryptocurrencies. Compare that to sovereign currencies. There are a limited number of nations, but even then there are 4 or 5 big economies. The Uruguayan peso will never displace the US dollar. But will Ethereum displace Bitcoin? Will Hamstercoin displace Ethereum? And oh, by the way, if people are going to take the time and effort and the intelligence to create new cryptocurrencies, will they have a back door so that they can have a few $1 trillion of their own? We're told that's impossible from the same people who say it's impossible that between 2017 and 2020, more than $19 million worth of Bitcoin and Ethereum were successfully double spent, effectively counterfeiting those supposedly tamper-free currencies. We are going to have one cryptocurrency after another, and those cryptocurrencies will have less and less protection. I want to commend Rashida Tlaib for talking about the effect on our planet, and I ask unanimous consent to put in the record this article from the Wall Street Journal detailing how whole coal plants that had been mothballed, that were no longer being used, are putting back online just to create electricity to mine Bitcoin. And
without objection, the document will be entered into the record.
One of our witnesses says that traditional financial systems use 5 times as much energy. Yeah, that's to do 500,000 times more transactions. Everything that's purchased on this planet at the retail level is purchased with a sovereign currency. It's the 5 times is a tiny percentage. We're told that the cryptocurrencies can be a hedge against inflation. We know that currencies are supposed to be a store of value. Well, the dollar does erode in value, perhaps 0.25% a month. You can buy Treasury inflation-protected securities and be fully protected from inflation. Or you can say that you're trying to get a good store of value, so you're going to invest in a cryptocurrency that could lose 1/4 of its value if there's a joke on SNL, as there was recently, and as we saw a nearly 1/4 drop. We're told that we're going to have know your customer at the level where you're trading and investing. But ultimately, these Bitcoin is supposed to be a currency. And so you transfer it to your individual wallet, and there it's totally anonymous. Yes, the records are maintained forever, anonymously. And with that, you have the perfect tool for those who are underpaying their US taxes by $1 trillion a year, concealing $3 trillion a year in income, and that means perhaps $30 trillion that has to be hidden every decade. Only with cryptocurrencies can we evade the effort to enforce our tax laws. That's why cryptocurrency is popular.
The gentleman's time has expired.
I yield back.
The chair will request that the gentleman place his question in writing for the record.
Thank you.
The chair will have to move to the gentleman from Ohio, Mr. Davidson, for 5 minutes for questions.
I thank the chairman and really appreciate this hearing. We've come a long way in Congress and just by having this hearing. So thank you. Thank you for the colleagues that have taken time to prepare for it. Some know the topic very well and some are just getting acquainted with it. And some, no matter how well acquainted, will remain hostile to the idea. Look, I won't spend long on Mr. Sherman's remarks, but China is building the creepiest surveillance tool in history. We should absolutely not emulate them. The whole fact that China is doing that is why we should be embracing decentralized distributed ledger technology that is more secure and does protect privacy. We could actually go further to defending freedom and restoring our Fourth Amendment constitutional protections in the financial sector by embracing the potential of this technology, not by being hostile to it. The third-party doctrine has annihilated the whole concept of privacy. And yes, we absolutely should keep the country safe. I could spend a lot longer, but I'm reminded of Proverbs 26:4, so I won't spend longer on his comments. But Ms. Sue, your testimony is the only one that I saw that discussed Tether at length. I'd like to delve into that for a moment. And, Ms. Goldstein, you spoke around the same topic. Last month, Tether revealed the breakdown of its reserves. In their disclosure, we learned that nearly 50% of its reserves are held in unspecified commercial paper of unknown quality. I looked at a few constant net asset value funds or liquidity funds held by larger banks to see how their composition compares to Tether's. While these funds are not a part of the crypto market, they are targeted for investors with surplus cash deposits who seek liquidity from their investments. Thus, they serve a similar function to Tether or other stablecoins. What I found when I looked into these liquidity funds was that commercial paper accounted for around 25 to 30% of their underlying reserves in the net asset value funds. Additionally, we know the quality of those commercial paper holdings and it's disclosed. Ms. Sue, based on Tether's disclosure, do you think there should be further disclosure regarding its underlying concerns? Composition?
Yeah, I think that one it was the first disclosure ever, and New York Attorney General's office took actions in investigating the case prior to its mandated disclosure as part of the settlement agreement. Some of the argument focused around the earlier promise of full backing and whether the disclosure come out to match that early promise. So.
Yeah, and definitely a relevant piece. It's easy to break the buck, particularly when you hold structured credit with undisclosed quality for the structured credit. So where they're at in the position is really important. It may not actually be a stable coin. Ms. Parker, in your written testimony, you said that the SEC is not comfortable approving traditional regulated products based in crypto, such as a Bitcoin ETF, even though it would, quote, provide more transparency into crypto markets. You go on to say, quote, because of this hesitancy, there are a lack of regulated products that are commercially attractive to market participants. Ms. Parker, can you expand on how regulated commercial products like a Bitcoin ETF and other traditional regulated products would bring additional consumer protection elements to the cryptocurrency system?
Thank you, Congressman. That's a great question. My point really is that they're not the sort of the Bitcoin ETFs, the leverage products, the margin products that are available on foreign exchanges that U.S. customers are routinely accessing through the internet with a VPN that provides, frankly, too much leverage, and they're likely inappropriate for most retail customers. So my point is to sort of stop that phenomenon. Let's counter with having U.S. regulated exchanges, securities exchanges, futures exchanges list regulated products that have some form of margin, that have some form of leverage, that's available to retail customers, that's appropriate for their sort of credit and suitability for their trading experience. So let's have this as a U.S. alternative to the foreign exchanges that U.S. customers can access because it's just a website. So let's have the Bitcoin futures, the margin products, the leverage spot products that U.S. customers are retail customers are desperately seeking at the overseas exchange. Let's have them in the U.S.
Thank you for that. I really appreciate it. It's a great point. Some regulation would be good. I'd love to talk more, but this is the point of the Token Taxonomy Act that's been bipartisan from its origins, and it would provide some regulatory clarity for what is a security and is not. Wouldn't do anything with the ETFs, but it would provide a basis for it. And if we can get to that, we really can do a better job of protecting consumers. Generally, when we want to protect consumers, we do provide some regulatory clarity. And we've had a great hearing on SPACs. You can have an ETF in SPACs, but currently nothing with Bitcoin. So thanks a lot. My time's expired and I yield.
The gentleman's time has expired. The chair now recognizes himself for 5 minutes. Dear friends, I do have some consternation. And my consternation emanates from 2008, when I, as a member of this very committee, sat down on a lower part of the dais. And I was here when then Secretary Hank Paulson appeared. He sat right out in front. I remember Cleaver was to my left, I believe, and Scott was to my right. The secretary wanted $700 billion. He had approximately, I thought, 5 pages asking for $700 billion. I've since read that it was 3 pages. Be that as it may, $700 billion to bail out what were called exotic products at the time. $700 billion. Well, as you can well imagine, my constituents were up in arms. They were calling me by the hundreds, demanding that I vote against a $700 billion bailout. Being the good steward that I am, I voted against it. And as I stood in the cloakroom and I could see the tabulation of votes, there also was a monitor, television monitor, and I could see the monitor indicating that the vote was failing, and the stock market was directly proportional to what was happening with the vote. As the bill failed, the stock market was going down. The next day, my constituents were calling by the hundreds. What is wrong with you? You voted against the bailout. My 401k is now at risk. I learned an important lesson. Do what you think is in the best interest of your constituents, even when they may disagree. This hearing is taking place because I think it's in the best interest of my constituents that we get a better understanding of what we're dealing with. I remember Secretary Bernanke. I have a statement from him that I'd like to read, and I'll do this quickly. Here's what he said. He said, this is Chairman Ben Bernanke, former Federal Reserve Chairman, that the $182 billion bailout of American International Group made him angrier than anything in the recession. AIG took risk with unregulated products like hedge funds, I'm paraphrasing, while using cash from people's insurance policies. He said the government had no choice but to bail it out. Who knew AIG was the glue holding the world together, the global order together? This is of concern to me. And Ms. Hammer and Ms. Goldstein, if I can get to both of you, I'd like your comments on my concern. You've mentioned FSOC. I don't know how that will help us with a living will, for example. This is of concern to me. How do we manage a behemoth once it becomes so big that if it fails, it may bring a sizable portion of the economy with it? Nothing is too big to fail, but you can be so big that if you fail, you'll hurt the economy. So, Ms. Hammer, let's start with you.
Mr. Chairman, thank you so much for your question, and I fully agree with your statements about the importance of evaluating potential systemic risk where taxpayer dollars are concerned. I often speak in my law class about the difference between an emergency response and a proactive policymaking framework. And the problem with an emergency response is that it's inherently backwards looking, and you create what's known as an emergency state relationship between the actors. We have the opportunity through the FSOC and Dodd-Frank Section 120 to create a proactive policy framework for cryptocurrency. That means gathering and evaluating data, coordinating the agencies, creating a committee that could consult with the many states that are legislating in this area as we speak, and consulting with international standard-setting bodies. And you mentioned living wills, Mr. Chairman. I think that's an important point because there are many aspects of our regulatory framework that still need to be ferreted out and relate to cryptocurrency. And so I strongly believe that's the place to start, and that we have resources to do it, and that by putting together our collective minds that we can tackle this problem.
Thank you. My time has expired. My apologies, Ms. Goldstein. But if you would submit comments for the record, I would greatly appreciate it. Dear friends, I thank the witnesses for their testimony and for devoting the time and resources to share their considerable expertise with the subcommittee. Your testimony today will help to advance the important work of this subcommittee and of the U.S. Congress in understanding and addressing the risks and opportunities inherent in widespread investment in digital assets, including cryptocurrencies. The chair notes that some members may have additional questions for this panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 5 legislative days for members to submit written questions to the witnesses and to place their responses in the record. Also, without objection, members will have 5 legislative days to submit extraneous materials to the chair for inclusion in the record. I remind members to submit their written questions and materials for the record to the email address provided to your staff. Dear friends, the hearing is now adjourned.